Welcome back to the Week in Markets. My name's George Bell, joined by Sam Elliott to give you an update on some of the key developments through the course of this week. Sam, should we kick off with a look at the markets and some of the key moves?
Yeah, sure. Thanks, George. So this week we've actually seen some softness within equities. Look at global equities, they're down about 0.5% over the course of the week. And just on a regional basis, that weakness has been pretty broad. But from an underperformance perspective, it's been Europe, which has been the laggard. Thinking about here in the UK, we've seen the mid-cap index underperform the large-cap index. UK mid-cap's generally more domestically focused. We've seen a lot of political uncertainty, which we'll come on to in just a second. We've also seen the banks come under pressure as well, so banks make up a big part of the UK index. There's rumours that banks will be subject to windfall taxes at the budget in November. In the US, that's also been negative, but actually less so than other regions, and one of the big drivers there has been Alphabet. So one of the big players within the US market actually won a court battle, which could have potentially seen them being forced to sell their Google Chrome business. They won that battle and the share prices reacted well, so that's been a positive driver within the US. From a multi-asset perspective, we've seen real strength in gold, so that's been a story that we've been observing throughout the course of this year, and over the last week, gold has been up about 4%. That's been positive, just given the weakness in equities, but also in bonds, so we've seen bond yields move higher, and that's really been the focus of markets this week. We've seen the gilt yield rise to a level which we've not seen in the past 28 years.
I think that's probably the area which has caught the most attention this week, the move in the gilt yields, and probably worth just spending a few minutes on there, because essentially what we mean by the gilt yield is that's the rate of interest which the government will pay you for lending them money through time, and they'll use that money for spending on areas such as infrastructure. The rate matters for many different stakeholders. One, for the government, because essentially they've already got a £100 billion annual interest payment on their debt, and that bill has just gone up as a result of this move in yields. It matters for long-term borrowers, such as mortgage holders. It matters for investors who own bonds. The price and the yield move inversely to one another. So as we've seen the yield go up, what you've actually seen is a fall in the price of the bond. And it also factors into many other different valuation models, which we use as an industry. It can be used to value equities, so stocks and shares. It can also be used to value areas such as infrastructure. So that move in the gilt yield can actually drive volatility in many other places as well.
So we've seen the yields rising through the course of August, into the end of August, and also the start of this month as well. What's been driving that rise in yields, George?
There's a couple of different factors. You've got more supply coming to the market, and you've got reduced demand. So in terms of supply, the government's already got a lot of debt. It's got about £2.8 trillion worth of debt, which actually comes to about 95% of the total value of the economy. And the plan is to extend that through additional supply of gilts into the market to fund the spending which is in place for the Labour budget, essentially. The Bank of England have been a seller of gilts under their quantitative tightening programme. So essentially this is them rebuilding their balance sheet after they injected quite a lot of liquidity into the market during the pandemic. So supply is actually increasing. And your typical buyers of gilts, particularly we're talking here at long dated gilts, 30 years and plus, essentially that was traditionally where institutional buyers such as pension funds bought a lot of the bonds which were offered by the government there. Their demand is actually reduced there. And also you've got the Bank of England who've been a seller, but also institutional investors, just given the confidence in the UK market has moderated essentially concerns around the fiscal stability which we have in the UK. So more supply, less demand. We've seen the yield push higher.
I think you mentioned the long end there, 30-year plus bonds. Is that just the only part of the curve which has been affected, or has it been across the board?
It's been affected to a greater degree in that part of the market, because the longer the term to maturity, the greater the impact in the move in yields. So that's where performance has been most challenged across the curve. But we have seen yields of 1 year plus move higher through the course of this week. But it's we saw some interesting developments from Andrew Bailey earlier in the week, essentially just trying to divert investors' attention away from the long end of the curve to focus a little bit more on what the debt management office have been doing more recently in terms of where they've been looking to raise capital, using shorter duration, shorter maturity bonds as a way of raising capital to fund spending there. But it's not just a move in the UK. We've seen similar moves internationally. Do you want to give a little bit of context towards the US and to Europe?
Yeah, we've seen a similar trend across both, like you say. So big parts of international bond markets, if you think about a multi-asset portfolio, a lot of that bond exposure is going to be coming via the US and also Europe. And we've seen the same sorts of themes. So we've seen bond yields moving higher for the same reasons. So concerns around government spending and how that's going to be funded, but also around inflation as well. So we've seen inflation coming down over the last couple of years, but that downward momentum has really stalled. And it's actually stalled at a level which is above central bank targets, so not quite reached the target. So there's concerns around inflation, but also how government funding in terms of their debt as well.
So we've seen yields which have been sort of pushing higher, more so at the longer end. But actually what we start to notice through the middle of the week is, particularly in the US market, the yield on 10-year government bonds, as an example, it did start to drift lower on some of the economic data. Do you want to give some context there?
Yeah, that's right. So we've seen the yield on the US bond come down by about 0.1%. And it's really been the jobs data which has been in focus there. So if you think back to the start of August, we saw the non-farm payrolls come in, and less jobs were added to the US economy in July than was expected. We also had revisions for the previous 2 months downwards as well. So a lot less jobs had been added than was initially thought. And that's continued on with some softness in the job data this week. So we look at job openings, so how many vacancies there are in the US. Those came down by just under 200,000, and that was a lot more than was expected as well.
Yeah.
We also look at survey data as well. So business managers within the US, within the manufacturing sector, and their intentions on hiring, those still remain soft as well.
Yeah. It's the cooling of the labour market. That's one of the aspects which the Fed have acknowledged in a lot of their commentary recently. I think it's quite a unanimous expectation that we will see another US interest rate cut this month. And that was really backed again this week by Waller, who's one of the voting members of the Fed, and unsurprisingly gaining a lot of support from Trump. So the labour market is having an impact in terms of how the Fed view the health of the economy, and it's really driving the expectation that there is scope to lower rates in the US as soon as this month. So quite a lot going on this week. Great roundup in terms of the markets, but also some of the key developments with really the gilt market gripping attention there. Thank you for watching, and we look forward to bringing you up to date next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.